What is going on, investors? Back again. Time to look at another recently IPO'd company that IPO'd this week, and that is DoorDash, ticker symbol a dash. We'll take a look at the valuation, which is coming in right now at about $60 billion. When it IPO'd, it was at about $40 billion valuation. It has shot up as high as about $70 billion, maybe even a little higher than that on the trading. We'll take a look at the numbers, okay? We'll take a look at the revenue, the profit. How are these, obviously, revenue is scaling up nicely. I don't think you even need to look at the company's financials to understand that, but how are costs scaling up and how is profitability or the potential of profitability around the corner? We'll discuss that when we look at these numbers, and it actually doesn't look too bad. Then finally, we'll jump over to the stock chart. A clear trend here is emerging and a level has formed, at least on the very short amount of data that we have here. And then finally, we'll compare this to Uber. I'll talk about some other restaurant stocks that it is being compared to, but from a stock market comparison, probably Uber is the closest that we're looking at. Now, the company raised about $3.4 billion in their IPO. This is a positive because this is going to flow, most of it, minus fees and probably things like that, are going to flow mainly to the company's balance sheet. It is going to allow this company to have lots and lots of cash on the balance sheet, allow it to make acquisitions, reinvest in their business, do those types of things. We raised about that amount of money on about 33 million shares. And again, it went public at a $40 billion or a $39 billion valuation. I want to keep that in mind as we move through this video. Now, at one time, this was published yesterday, the company reached a $70 billion market cap, meaning that DoorDash was worth more than Chipotle, which is a $36.9 billion company. It's worth more than Yum Brands, which is a $31 billion company. It's worth more than Domino's Pizza, which is a $15.3 billion company. And finally, it's worth more than Dunkin' Brands, which is an $8.8 billion company. In fact, at a $70 billion valuation, and even at a $60 billion valuation, and even at a $40 billion valuation where the company went public, only McDonald's and Starbucks in the restaurant sector have a higher market cap than DoorDash. I will let you see if that makes any sense. At the current moment, DoorDash's price to sales ratio is at about 23, and I'll show you that here in a minute. Now, Uber's price to sales ratio is at 7, and it has been steadily climbing actually over the past year or so. Whether or not this valuation makes any sense or not, Uber is about, I think, about $80 to $90 billion company off the top of my head. But again, they trade at about 7 times sales, and DoorDash trades in the kind of high teens to 20x price to sales ratio. Let's jump over to the numbers. See if these valuations make sense. For this valuation to make sense, you need absolutely hyper growth on the top line, and that does fit the bill when you're looking at DoorDash. Notice we've got 3 months ended here starting in March of 19, goes all the way to March of 2020. So here's a year-over-year view, plus we get an extra 6 months here as well. And these extra 6 months are, in my opinion, are critical to the company. So we see here, back in March of 19, we were at a $133 million valuation. A year later, we were up to 362. Obviously solid growth, but the company has absolutely accelerated this revenue growth. Take a look at the 2 most recent quarters where we went from 675 in what is considered for most people about Q2, and then in Q3 all the way up to $879 million. That's obviously phenomenal growth on the top line. Now, the more important thing is how are these costs scaling up? So we have cost of revenue here, and this isn't what I would call necessarily a high margin business. We did a video today on Adobe, and I would actually consider that a high margin business, at least from a cost of revenue or cost of sales perspective. Now, DoorDash, not necessarily in that boat, but this is pretty good margins. We see we spent 98 to make 133 in our latest data, but in our most recent quarter, we spent 382 to make 879. So that's actually pretty good margins if they can control their sales and marketing, research and development, and general and administrative costs. And we see here these costs have trended up in the most recent period, but obviously you'd expect that because we have such rapid growth. Now, I'm going to dissect these costs a little bit more on this screen. It's a little bit better representative, and it's going to give you a better idea how well the company is scaling up things. But I do want to look at it from a total cost perspective. We've gone from 327 to a year later at 485. That's not that bad. And then up to 914. So it has accelerated more recently. Notice we spent $914 to make $879, so we lost $35 million in the most recent quarter. But take a look at our income, or in this case, mainly loss from operations. It actually isn't that bad. I've seen companies that just spew money far more egregiously than DoorDash. We lost $194, and it's been relatively consistent, kind of in that mid-100 range. We actually turned positive in the June quarter at a $27 million net gain from operations, and we lost about 35 of it back in the most recent quarter. Quite frankly, it's not that bad, honestly, from a loss from operations perspective. I was actually expecting this company to be bleeding more cash than it was. We'll see if that continues going forward. Now, here's a better way to kind of look at costs. And if you've never seen a chart like this, what it does is it put revenue or sales on top. And obviously, this company gets 100% of their income from their revenue. And then it shows you how these costs are a percentage of the revenue. You notice here in the March 19, we spent 101% of our money to make 100% of revenue. I'll show you that up here. We spent 135 to make 133. So that is a 101%. So we're obviously losing money just on sales and marketing, not including any of these other expenses. Notice that our total costs and expenses were 246% over our revenue. And so obviously we lost quite a bit of money, about 146%. But notice how this is actually scaling in the right direction. In fact, it's across the board. Notice that our cost of revenue was 74% back in March, and now it's 43%. We went from this is probably the most encouraging thing. We went from 101% sales and marketing expense down to 33%. These companies are always going to have to do sales and marketing. It's a competitive environment. They're going to have to not only sell themselves to the restaurants, but obviously the customers that use the app as well. And we got research and development that has gone down from 15% of cost down to 5%. General administrative, this is probably the most impressive, went from 53% all the way down to 19%. So this company is scaling up actually rather nicely. We see we're still spending 104% of our revenues, leading to a 4% loss on our revenues. But again, we were at way over 100%. We were in the mid 60s, in the 40s, 30s, and now we're in the right direction. If this company can keep this up, keep this revenue growth accelerating like it has over the last, call it 12 months, and keep these costs in line, this is going to be a challenge. I'm saying this, but for me, I would like to see this before I believe it. But if the company is able to grow its top line and keep these costs in check like they have, this is a pretty good business in my opinion. Now, let's take a look from the valuation perspective. What I did is I totaled up the last trailing 12 months, but it's tricky with DoorDash because we're growing so rapidly over the last 6 months. This is close to we'll just call this $1.5 billion worth of revenue. So you want to times that by 2, you're at a $3 billion run rate. You're still at a 20x multiple on sales when we talk about this. So what I did is I did the trailing 12 months. We were at about 2.2 billion. This is in thousands, but these numbers are in millions. So this is $2.2 billion. Again, at a $2.2 billion, sales over the last trailing 12 months, you're closer to a 25, 30 billion, 30x on sales. Again, we looked at Uber. They are at a 7 multiple. So for this to make sense or to compare it to Uber, this stock would have to come down massively. I mean, we're talking like 60, 70% in terms of making a little bit more sense if you want to compare it to Uber. Now, it's probably growing a little bit faster on that top line than Uber, but Uber's business has been disrupted probably slightly more than DoorDash is over the last 6 to 12 months or so. Now, we take a look at the stock chart. I've got it on a minute view, a minute time frame to give us the most data points. There's clearly a level here where buyers step in. It could be the big investment banks are supporting the stock at the 174, 175 price, a little bit lower than that. You're looking at around 173. That is the first level where if I was trading this stock, that'd probably be where I'd first step in. I don't think the valuation makes enough sense to me right now to where I'd want to buy these shares to go along. Now, again, everything looks pretty good. Everything looks great from a top line perspective. Things look better than I would have expected from a total cost perspective. I still think this is a show me stock. And I think the valuation in comparisons to a Chipotle, to a Domino's Pizza, and certainly a McDonald's and a Starbucks probably doesn't necessarily make a lot of sense, considering DoorDash doesn't necessarily have anything proprietary that keeps other competition like Uber, like a Lyft, or any of the other food delivery companies that exist out there to come to market and compete, pretty strongly against DoorDash. So this stock is trading at about 181. I wouldn't touch it from a trading perspective until we pulled back to support here. If this stock breaks this 174 level with any kind of momentum, it's anyone's guess where this stock is headed. Okay, this, in my opinion, is a pretty critical level, at least in the short term. Any break below it, and this stock, who knows? There's no price action down there below it. But although you do have, with these IPO companies, you do have the big investment banks that will step in occasionally and support this stock, at least for the short term. That's why I like to look at these IPO companies. I like to analyze them. Sometimes it makes me want to go buy some of these other companies because of how much of a rich valuation this one has in comparison to these other ones. In this case, I'm going to stay on the sidelines. I'm going to monitor what happens. I'm going to keep an eye on Uber like we always do here on the channel. And we'll keep an eye on what happens with DoorDash. But in my opinion, probably slightly too probably very too volatile for my taste. And I would wait until a lower valuation comes with this stock to potentially go along with the share. So that was DoorDash. Hopefully you guys enjoyed this one. We'll be back again soon. Good luck with your investments.